Hello, Professor. This is our group presentation. For the beginning, I will introduce the null and alternative hypothesis. First, the term null hypothesis usually refers to a hypothesis that, in most situations, does not have an impact or differences. It is typically used as the starting hypothesis in research that must be verified. The null hypothesis usually attributes the discrepancy in sample data to chance mistakes and inherent variance in the sample. For instance, the null hypothesis in studies on long-term and short-term investment portfolio construction usually presupposes that investors will not see appreciable returns on their investment. Therefore, in the null hypothesis, the return is usually equal to zero. Second, typically, the alternative hypothesis is a counterargument based on the sample's null hypothesis. In other words, the hypothesis that is accepted when the null hypothesis is rejected is the alternative hypothesis, which often indicates the presence of effects or differences in the sample data. Consequently, the alternative hypothesis proposed that while building a long-term, short-term investment portfolio, one should expect that the portfolio would yield substantial returns for investors. It follows that the return is often believed to be greater than zero under the substitution assumption. Third, generally, the fundamental components of hypothesis testing in statistics are the null hypothesis and the alternative hypothesis, which are used to infer the general properties of the data. Next, I'm going to talk about the methodology of this project. It's called long-short portfolio. First, I'm going to talk about how it works. The long-short strategy is a fundamental trading approach when investors takes long positions in stocks that are expected to increase in value and short positions in stocks anticipated to decrease in value. The strategy aims to capitalize on both the upside potential of the long positions and the downside potential of the short positions. This strategy allows you to profit from ups and downs in asset prices and is not dependent on the whole market going up or down. In long positions, investors select stocks they believe are undervalued or have strong growth potential. This aims to profit from the appreciation in a stock's price over time. In short positions, investors identify stocks that they consider overvalued or likely to decline. The goal is to profit from the fall in the stock's price by buying the shares at a lower price. Next, let's look at the characteristics of this strategy. First, the advantages of this strategy. First, diversification. The strategy includes diversification effect as it spreads investments across various stocks and sectors. Doing wide stock selection, investors can diversify the market risk and avoid large losses caused by market fluctuations. Second, hedging. Short positions act as a hedge against market downturns for long positions. This can reduce the loss when the market is not performing well. But this strategy also has some disadvantages. First, complexity. It requires sophisticated understanding of the market system and active portfolio management ability, which is difficult for individual investors. Second, short selling risks. Short selling involves risks such as unlimited losses and the potential for short squeezes. Unlike buying stocks, where losses are limited to the initial investment, short selling can lead to unlimited losses because there's no cap on how high the stock's price can go. And the short squeeze happens when stock rises and short sellers cover their trades by buying back their short positions, which further drives up the prices. Third, costs. The long-short strategy usually has a higher transaction cost due to numerous transactions and higher financing costs for borrowing stock shares. Fourth, regulatory constraints. It also faces certain regulatory constraints and reporting requirements. In practice, implementing a long-short strategy requires a deep understanding of the market dynamics and the ability to make informed decisions based on a comprehensive research. It's not just about picking winners and losers. It's about managing a balanced portfolio that can withstand market fluctuations and deliver consistent returns over time. So this strategy is often employed by hedge funds and sophisticated investors who have the expertise and resources to conduct detailed analysis and manage the associated risks.
So how do we use codes to build a long-short portfolio? We have the following steps. At first step is read data from different data sources, then clean and transform this data uniformly for later analysis, and finally summarize them into a dictionary. At first, we can see the picture. We use this read function to read information from the CSV file containing stock price data, then organize the adjusted closing prices of all stocks into a pandas series. Then we use this function to calculate the daily return. And then it's same as the monthly return. Finally, we merge the daily and the monthly into a dictionary. The second step is calculate the volatility according to the previous calculation results. At first, this function using the daily calculated previously to calculate the monthly volatility. And after that, this function merged the volatility calculated in the previous step with the monthly calculated earlier into a table to facilitate the construction of portfolio later. And then we need to short the stocks in the first quintile each month and then go long the stocks in the last quintile to construct the long-short portfolio. At first, we use the stock sorting function to divide stocks into Q quintiles and give each stock a ranking. After that, we calculate the average return for each portfolio. Finally, firstly, we reshape the feature data box and then sort the stocks into Q groups and then finally build the portfolio.
And about the average return and t-statistic. The average return of long-short portfolio indicates the mean profitability of the strategy over the specified period. A positive average return suggests that strategy on average generates profit, whereas the negative average return indicates a loss. If the average return is substantially positive, it implies that strategy of going long on low volatility stocks and short high volatility stock is profitable. The t-statistics measure the significance of the average return. It is calculated as the average return divided by its standard error. A high absolute value of the t-statistic, typically greater than 2, indicates that the average return is statistically significant, implying that observed profitability is not due to random chance. A low t-statistic suggests that average return is not statistically significant, indicating that the profitability of the strategy might be due to randomness rather than a systemic pattern. For the question 4 is reliable of the result. First is sample size. Large sample size number of observations generally leads to more reliable result, as it reduces the impact of outliers and anomalies. If the number of observations n is large, the results are more likely to be reliable. Second, consistency over time. If the results are consistent across different time periods, it suggests that the observed pattern is not a result of the specific time frame, but rather a consistent trend. Third, statistical significance. The t-statistic provides a measure of reliability. If the t-statistic is high, it indicates that the average return is statistically significant, making a result more reliable. Fourth, economy rationale. The strategy should have a sound economy rationale. In this case, the long-short strategy based on volatility is backed by financial theorists, suggesting that low volatility stocks tend to outperform high volatility stocks over the long term.
So for the next part, we have listed the main flaws in this group task. Firstly, data quality concerns. In our group project, there are some missing data, and as we all know, error news or missing data may provide inaccurate findings. Inaccurate data might discourage investors from going long or short and possibly lead to losses because most investment behaviors in today's markets are preference-based. Our investment portfolio construction process could not be able to fully capture the intricate features of the market, and the resultant portfolio would not be the best combination and might miss certain potential profits. Thirdly, the accuracy of the findings obtained from our statistical approach might be compromised if the data doesn't conform to the normal distribution assumption. And then for the to-do list, at first, the sample size and the time range can therefore be extended and improved in the future. We can make the estimated findings more authoritative and reduce mistakes when we have more data over a longer period. After that, all our data analysis for the project could not apply to real market trading. And last, use more complex models, including multi-factor models. These models can provide investors with more useful advices. Okay, that's all. Thanks for listening.